Hello, business owners. I want to talk about two important aspects with the new government bill that passed July 4th, 2025. And before I continue, it's really important you go do your own research on this bill and or speak with your accountant to get advice, because obviously they'll do the research with regards to the tax part. So the first thing I want to discuss is it says you're able to completely 100% expense a number of things like building a factory or equipment. Again, go see the bill yourself to see what it includes, because there's a bunch of various things on there, like there's computer stuff, things like that. It allows you to expense it all in 1 year versus for the normal term. So computers, I believe, is regularly 3 years, and then equipment and stuff can go up to like 20 years. So they're saying instead of depreciating it over that term, you're allowed to depreciate it, hence expense it in 1 year. Why is this something you would consider doing? If you can expense it in 1 year, you offset your profits with that, which means so let's say it's a $100,000 piece of equipment. If your tax rate, if you normally pay, say, I'm just making this up, 30% on that, you'd pay 30 grand in taxes on that piece of equipment. Now, if you depreciate that over 10 or 20 years, that tax would apply over 10 or 20 years. In this case, it would apply in 1 year, which means you save the taxes in 1 year. You don't save money in the long term, you save cash flow, which means now you've saved that $30,000 in cash flow year one. Why would this be a good thing? Because you can take that $30,000 and go invest it in something else to grow. So this is a great idea if you're a business that's in growth mode or looking at growth mode and you have a smart business plan for that growth. In other words, you're not just trying to grow not profitably, which will get you in trouble faster. You got to grow profitably. So if you got a great growth plan, you can use that tax savings to invest in more stuff to grow quickly. And they say it's over the next 5 years. So in theory, you could, again, pretend it's a $100,000 piece of equipment. You save 30 grand in taxes in a year. Again, just an example. You can reinvest that immediately into more equipment for growth and then apply that to a 1 year depreciation again, and then save the tax on that. And you kind of keep stacking it on top of each other. So it's fantastic for growth mode. The risk of that would be if you save that tax in that first year and then you take that and go buy a personal ski boat with it. That'd be pretty stupid, because now you're not taking advantage of the purpose of it, which is to help yourself grow, be more profitable, etc. So that's the one thing to consider. And that's a pretty easy one. I think a lot of people probably understand that. The second thing to consider, and this is maybe more complicated, is the number one reason businesses are not profitable by far and away is they don't understand how to price themselves properly. They don't understand how to price their product or service properly, or what they're going to carry and how they margin blend it to be profitable. In our program, we go through that in detail and make sure we have a pricing tool for that to make sure you do that properly. But just a quick overview, you got to make sure your pricing on every single product or service covers your expenses plus your profit. So if you know your expenses are 35% of revenue and you want 15% profit, 35 plus 15, my margin needs to be 50. My blended gross margin's got to be 50. So I have to achieve that. Now, if you expense a piece of equipment in 1 year, then that increases your operating expenses as a percentage of revenue. If you're understanding how to price properly, like I just talked about a minute ago, then your operating expenses just went up as a percentage of revenue, which means you're now going to increase your prices, which you might price yourself out of the market. Or you may not increase your prices and then your profit drops, which means next year the profit would increase based on now you have a lower operating expense as a percentage of revenue, because now that expense isn't depreciated over more than 1 year, it's just in 1 year. My point is, really make sure you understand how you're margin blending, why you're hitting that margin percent, because it's supposed to be your profit plus your operating expense percent. And if you don't fully understand that, please reach out, get advice, learn how to do it, because if you do it wrong, you're on the path to trouble. And if you take advantage of this tax break, which is great, but you don't understand how to price properly over that period of time, you might get yourself in trouble. So you have to sort of understand both. Big piece of advice, if you want help with the pricing and the margin blending, go check out our website, see if there's a program that helps you fit your needs.